Hi, everyone, and welcome to a new episode of the Peregrine podcast. Today, our guest is Ed Moisson, the author of a timely and important new book entitled The Economics of Fund Management. I began by asking Ed what led him to write the book and why he felt there was a bigger story to tell. We then moved on to the problem each asset manager faces and how its brand and the methods this tries to convey stands out from competitors. We then discussed how investment managers have sought to portray their commitment to the environment and social responsibility. Then we turned to the passive-active debate, how ESG funds reflect the growing power of analytics providers like MSCI, and whether we're at the high watermark for passive allocations to dominating fund flows. Next, we discussed how more attention being put on sustainable investing has increased the focus on asset managers' credibility and the degree to which their claims are authentic. Finally, we discussed how the investment management industry is confronted by two futures, which reflect conflicting views of fund management. One view looks at maximizing revenue and avoiding the impact of a squeeze on fees, and the other is willing to interpret fiduciary duty as including a commercial dimension, namely to help clients improve their returns. Welcome to the Peregrine podcast, Ed. Perhaps you could begin by telling us what led you to write the book, The Economics of Fund Management, and why you felt there was a bigger story to tell.
Thanks, Bill. Well, yeah, thanks for having me. Thanks for having me on. I guess partly it was looking at what books were out there on the industry in the first place, and it struck me that about 99.5% of them were on what portfolio managers themselves do. Strategies for investing, tips on how you can invest, and so on, which I think is perfectly understandable. But I thought surely there's a little bit of a gap there to work out or to have a closer look at what is going on with the whole of the rest of the industry. And I think that you went through pretty exhaustively my career to date, and in amongst there was spent a couple of years at an asset management company. And there it really struck me as well, the dynamics between the different parts of the business and how important the other bits beyond the portfolio management team, albeit obviously that sits at the heart of an asset manager. It struck me how, those dynamics, how they interact with one another, and how important parts of them are, in perhaps a way which is less understood by the wider world, was something that could be explored a little bit. And I suppose accompanied to that was, that as a topic to look at. On the other side, personally, I'm a journalist for a daily news title. There was a chance to be doing something which wasn't, the rapid turnaround of articles on a daily basis, and have a chance to sort of have a bit of a sit back and reflect on the industry and thoughts I'd had over the years about how the way that it works, and that slightly sort of change of pace, I think, for me was quite appealing on a personal level as well.
Well, you've certainly given us a bird's eye view of the way it works, the attention to detail and the analysis of all of the different parts of the fund management industry that, for the most part, many investors, certainly retail investors, never see, because they really only think of it in the context of investment decision making and whether you make money or lose money. So you've certainly succeeded in showing a much broader, shall we say, landscape that spans an asset management company. I wanted to turn though to one of the issues that you mentioned, and this is you discuss how each manager, has a brand and a message they try to convey, and they use this to try to stand out from competitors. But you strike a critical tone by noting that most investment companies have converged with similar brand attributes, and that to some extent this has been played out in how investment managers all to some extent sound alike and tend to say the same thing. What would you say about how this played out in terms of how investment managers have sought to portray their commitment to the environment and social responsibility?
Yeah, it's been an interesting one. I think the way that firms market themselves, there's quite a lot of stuff that's going on there that we can maybe unpack a little as we chat. On the ESG side, I think that's been a particular issue because firms over recent years, and it's still very much, working in the industry, it feels as though people have been talking about ESG for quite a while now. But at that heightened level where journalists and things are covering stories regularly on it. But it's still, I think it's still very much an evolving area in the way that firms present themselves, present their credentials on it. And I think, yes, this issue about differentiation is an issue when you have a mix of firms at different stages in their evolution on ESG. There are a relatively small number, tend to be slightly smaller firms that have been pretty, I was going to say hardcore. That's a bit sort of flippant. Be much more focused on different elements of the ESG, environmental, social, and governance world for many years. So yeah. There is that smaller group of firms that either are dedicated impact investors or account for ESG factors within their investment process, or take account of sustainable factors in other ways. And so they have a long track record and something which I think they can present themselves very credibly and point to that track record. Mm-hmm. To oversimplify the industry, there is then a lot of other firms that realize they can no longer sort of ignore that part of the world, either for regulatory reasons or for client reasons. You need to be presenting a credible approach to the way that you're integrating ESG, or trying to go further than that and trying to be an impact investor of some form. And I think that then is where you get the problem, is those latter firms, again, on our overly simplified spectrum, as it were, those latter firms are then trying to play catch up in being able to present themselves as being credible ESG investors, because if they're not credible, then money presumably will flow to their rival firms. And I think there's a problem because marketing departments have been very, have latched onto this and realized we need to be showing that to the outside world. And it's not complicated to, I appreciate this as a simplistic level. It's not complicated at a simplistic level to have an advert where you have, pictures of the environment or people from, underdeveloped parts of the world where you're trying to, use your capital to help their situation and present that as you as an asset manager are doing good in the world. That's not a complicated message. The problem comes in, is what you're doing in reality as portfolio managers and stewardship teams or so, does that match those credentials? And very clearly for some firms that is a problem.
Very much so.
That's been a problem, not just in meeting the regulations, but also in some high profile cases we've had around accusations of greenwashing and so on.
Mm-hmm. No, absolutely. One thing that I was really taken aback by in your book was when you noted that MSCI, if it was treated as an asset manager rather than an index provider, it would be the largest sustainable fund manager in Europe. And you advance this to show how ESG funds, reflect the growing power of analytics providers like MSCI. And you go on to observe that the practicality of integrating ESG criteria favors active managers who can tweak their investment strategies to meet investor demand for sustainable funds. And obviously, passive funds are severely limited in their ability to divest from a company that is included in the index it tracks. Do you think that we're at a high watermark of passive funds' domination of investment flows in the way that we've seen over the last couple of decades?
Yeah, I suppose I should just start by saying that that was me intentionally trying to use some data to illustrate exactly the issue that you've pinpointed there. I'm sure that I'm sure for a fact index providers themselves would not view the world in the way that I have done, but I think for exactly the reasons you're saying, that the importance of index providers and similar analytic type firms in underpinning a lot of passive funds is something that I think the industry is having to get to grips with. And on your question about the high watermark, funnily enough, actually, no, I don't think so. I think, I think for two reasons. One is, I don't think every pound of money or euro of money being invested in funds, the investor contributing that money is totally motivated by trying to make a difference to the world in relation to sustainable investing. I still think there's an awful lot of money that is, step one is, how can I generate a positive return for the long term? That doesn't mean you can't consider ESG factors, but I think once you've got that first step that on long-term returns, then that does mean that you're going to have to be directing capital to companies that include fossil fuel companies. And added to that, I would say, the way that passive firms present themselves on this does vary, but I think if a passive firm presents its ability to be a good steward of the money that it's managing, so that, say, Vanguard, holds BP or Shell to account on what they're doing and how they're transitioning to, a lower carbon economy. Yeah, I think that's a perfectly reasonable step to take. Now, I'm sure climate protesters will say those investments can never be good enough. But I think for a lot of people, it's not an outlandish thing to say that is a credible position to take. That if you do stewardship and engagement properly, then that is part of the ESG world that the investment industry is moving into, and that could be on a FTSE 100 fund as much as a FTSE 100 climate change fund.
Sure. Well, you mentioned stewardship and engagement. I think those are some of the key factors in sustainable investing, obviously. And one of the things is that it's so important for fund managers in this area to be able to show they're authentic. And obviously, stewardship and engagement is a way to do that. I just wonder, to what extent do you think it's vital for asset managers to convey purpose in what they do in order to show authenticity and credibility?
Yeah, I suppose I think a lot of this. I think this is the area that people are going to be looking at more closely now. Is not so much the purpose bit, but how you convey things, how you're demonstrating what you're doing. I don't know if that's what you're getting at with your question, but that demonstrating that it's one thing to talk about. Yes, we hold companies to account for what they're doing. It's another thing to actually be able to say, look, here is our voting record. This is what we've done, and that ability and hopefully greater scrutiny of firms trying to demonstrate those commitments or that purpose. Yeah, I do think that is an important part, and I can only think it's going to be increasingly important that once we're sort of moving on to this stage where ESG integration, i.e. considering ESG factors as part of your investment process, is pretty much ingrained across the entire industry. Obviously, there'll be parts that maybe don't care about that stuff, that's not, but in the main, that as a sort of becomes the baseline for which an investment manager operates, then yeah, exactly how they're doing that integration, how they're translating that into how they're interacting with the underlying companies. Yeah, I think it's going to be fundamentally important. How you present that to other people, I think that's an area, not surprising, that's still evolving. Showing a 200-page document of these are all the different votes that we did over the past year is pretty incomprehensible. But it's those kinds of things that firms are. Clearly, you see firms doing this already in laying out what they've done on their voting track record, and that sort of stuff I think is going to be pretty important. Yeah.
No, you've hit the nail on the head, because it's an area that unpacks a huge amount of data and a huge requirement, shall we say, for processing that data. And obviously the voting track records of firms is something that's amorphous in terms of the amount of detail there is and the number of votes there are and all the rest of it. And some of the models that are used in ESG, would only be possible with the development of algorithms in the last sort of 10, 15 years. Obviously, earlier ESG models were, much more simple and confined, whereas now they're, incredibly complex and evolving and sophisticated. And, some firms obviously that are doing sustainability analysis over, say a 10, 12, 15-year forward-looking view, they're factoring in 60, 70, 80 different variables where they're trying to determine, the sustainability of a company and its cash flows and its impact on different ESG criteria.
And sorry, one other point I'd add there is obviously what we've also begun to see is firms, both asset managers and pension funds as well, I think, trying to get a better understanding of what their clients want in terms of engagement and voting and so on as well, which adds a whole nother level of difficulty to this. It's not just that an asset manager thinks company X should be paying its staff better, but also the investors within the fund that you're managing. What are their views on that topic, or on, investing in fossil fuel companies and so on? And that adds in then potentially more data and information, which funds can be taking account of or not. And I think that's another area where we're seeing, firms trying to get to grips with this, particularly on the passive side as well, I guess. It comes back to the earlier comments, yeah.
No, it's very much almost like a three-dimensional chessboard, if you recall such things from sort of the 80s and the 90s, where you have, on the one hand, a dimension with investors, pension funds, endowments, etc. On the other hand, you have a level with the actual asset managers. And then in a sense, there's a third dimension with various other stakeholders who are, rule-making bodies and index providers and outfits like UNPRI, etc. So the interplay of all these things is massively complex, that's for certain. But I wanted to turn to, kind of a prevailing theme of asset management industry analysis over the last few decades. And this is the conception of the so-called squeezed middle. And for listeners who might not be aware of exactly what that means, it really denotes a process whereby the top 20 or so firms, the PIMCOs, the Vanguards, the BlackRock, get bigger and bigger and bigger. And then all the rest of the firms sort of bifurcate between those who continue to grow and are quite large, and then sort of niche boutique operators who are, shall we say, on the other side of the scale. And, we've seen through, in recent years, certainly the rise of BlackRock to more than $10 trillion, and, various firms in the mid-sized space, merging, like, Standard Life Aberdeen, or Aberdeen without the vowels, as it's now known, and then other forms of amalgamation, etc. And yet I noticed in your book that the research shows quite healthy profit margins, often in the 15 to 30% range across many firms, almost regardless of size, whether it be a $10 billion boutique or, a huge, $1 trillion firm like Blackstone. And you note in the book that there's about 1,600 firms in Europe with below 20 million euros in assets, and thus outside of the top 100 firms. But you've noted a certain resiliency amongst these firms. And I wondered, is this resiliency just because there's a lot of clever people out there running these firms and, making their way? Or is it due to a lack of real price competition and some market inefficiency? Or is it maybe more indicative, as I mentioned a moment ago, of a firm's ability to be innovative and develop new products and, provide investment performance that clients value? Or is it a mixture of these things? I'd just like you to comment on that a bit, if you could.
I think, the idea of the squeezed middle of medium-sized firms suffering, I can't help thinking that a lot of that has come from a US perspective of the way the world works. You mentioned various big passive firms. Obviously, they're biggest in the States. And also in the States, as with any market, you have a home bias on investing. So most assets are going to be invested in US equities. And US equities, as we know, is one area where passive investing in particular has done particularly well. The efficiency of the market has made it more difficult for active managers to perform well, and passive firms have picked up as a result, and therefore you increase the shift of money towards passive funds. And so I'm not an expert on the US industry, but that my impression would be this idea of a squeezed middle may well work within the confines that I've described, particularly focused on the US industry. If you then look at a global view, US fund houses with their US businesses make up such a large proportion of the total that your global figures are skewed towards what's happening in the States. Now, what I've tried to do here is to question whether that works in Europe in particular, because, as you say, there's a lot of UK and European firms that aren't the biggest that are doing very well indeed. That's not just in terms of profitability, but in terms of flows or, the potentially for their funds performance and so on. And that, I think, that last word, performance, I think is where part of this comes. Just because you're big or small doesn't mean that you're going to perform better than a medium-sized firm, or it doesn't have to. The performance of the fund is going to come down to the performance of an individual portfolio manager and the team that he or she has got around them to deliver good performance. Now, I can see as a business, if you got more better run funds or funds that are positioned at the right time at the right place, so you gather inflows as well, that you can then grow your business and get bigger. And that's clearly the case. But that doesn't mean that, I would say, that doesn't mean that just because you're medium-sized, you will suffer as a result. Partly as well because medium-sized firms are still pretty big. They're still managing at large sums of money. And yes, if you can still charge the competitive fee rate, you can still be pretty profitable. So that is, I suppose that's the idea, is to, do the dynamics that we think work globally, do they happen in Europe as well?
No, very good point, and very, very well made indeed. I mean, one of the things when you mentioned about, if you can have an appropriate fee level, then you can be very profitable, is quite interesting from my standpoint as someone who works more with alternative investment managers, to see, for example, that, a year or 18 months ago, BlackRock had a much higher market cap than Blackstone. Not surprisingly, given that BlackRock managed about $10 billion and Blackstone is shy of $1 billion. But in the last year or so, the market valuations have pretty much come together, and they're more or less similar. And I guess part of the shrinkage on the BlackRock side is because it's in a more commodified volume type business, whereas Blackstone, being a more specialist alternative investment solution provider with real estate and hedge funds and private equity, perhaps has a bit stronger fee trail, and that accounts for it being able to be valued at a similar rate despite having 1/10 of the asset.
No, absolutely, and I think it's exactly that dynamic that is pushing more what one might call traditional asset managers to be looking at alternative strategies, which a few years ago would have been hedge funds, but now it's investments in private markets. So you see BlackRock, all of the big firms talking about bulking up their private markets capabilities, which is very definitely a shift in emphasis. And I think the attractive fee levels, obviously they would present it to fund investors as these are attractive investment opportunities. When they're talking to their shareholders, they point to the attractive fee levels that they're able to generate.
No, absolutely. There's certainly a tension between those things. I often wonder, given how private markets have swept all before them in the last sort of 10 years or so, and did so well in effectively a zero interest rate environment, I've wondered, just now that we're into a rising rates environment, whether those types of strategies can sort of do what they've done in the past 10 years. I don't know if you have any thoughts on that, or.
Yeah, you're pushing me outside of my comfort zone, Bill. I think you're probably right, but I'm not an investment expert. I certainly think it's. I suppose just generally, this is slightly simplified version. It tends to be that when you see big investment fads in the mutual fund world, be that absolute return or 130/30 funds not too long before that, the industry moves en masse into a sector just at the wrong time. So that doesn't mean that private markets will fare less well, but if the industry's track record is anything to go by, the mass movement into these sorts of investment opportunities, I worry that's almost the signal that it's going to be more difficult for those sorts of strategies to be delivering for their clients.
No, it's certainly something that will make interesting viewing over the next few years as we go through this, I guess, tightening cycle, but probably a tightening cycle that is going to have characteristics and certainly has a backdrop, unlike any other tightening cycle we've seen, certainly in our lifetimes, and probably far before that. But I wanted to just look into one other thing from your book, and this is your conclusion where you argue that the investment industry is confronted by two futures, as you call it, which reflect conflicting views of fund management. You characterize one view as looking at maximizing revenue and avoiding the impact of the squeeze on fees, with another view which is willing to interpret fiduciary duty as including a commercial dimension, which means, of course, lowering fees to help clients with improved investment returns. You characterize this as one view looking to the expected demise of the mutual fund, and the other looking to embrace the principles embedded in the mutual fund. How do you see this playing out over the next decade or so?
Yeah, that's a tough question, Phil. It's difficult. I suppose my concern is that generally the industry, when it comes to commercial factors, which in the main part is just fee levels and the way that fees are charged, the industry, certainly from my UK European perspective, it generally moves when regulators tell it to move. So in the UK, the Retail Distribution Review, to a limited extent, the impact of MiFID II, and those sorts of things, and we see it on the same side on ESG, that a lot of the activity and sort of comings and goings we've seen in relation to ESG product development relates to regulations. I mean, and I guess that's unsurprising. But if we're then looking to the future as to how asset managers are going to, look after their bottom line, are they therefore going to be, following my sort of slightly more, client-friendly view? My concern would be no. And that's because, a CEO ultimately is most concerned about growing their business, which is completely understandable. I suppose I think it's interesting, and one reason why I think the funds industry is an interesting area is because asset managers, have two client bases. They have both their shareholders, which, okay, not all are listed firms, but in principle, you have someone who's interested in how you're doing as a business, and then you also have your fund investors, and that is a tension which I tried to explore in the book. And for firms to be embracing the sort of view that you've touched on there about lowering fees to help clients, to help fund clients, that's likely to have a hit in the short term. At least it's likely to have a hit on their how they operate as a business. And unless a regulator is forcing them to do the latter, then that's going to be tricky. And actually, and I think in particular, that's why in the UK, when the UK Financial Conduct Authority, the regulator, a few years ago introduced its assessments of value, which I think a lot of people initially sort of thought, well, this seems a bit it's sort of vague and woolly. What underpinning it, I think, was quite a radical view from the FCA that they should be pushing firms to get to grips with pricing, outside of market factors. That in a capitalist economy, I think a lot of asset managers thought, well, no, I should be allowed to charge whatever fees the market would bear, be that raising them or lowering them, because that's capitalism in action. The market decides. Whereas the FCA was coming in and saying, no, you need to be reviewing your fees and being able to justify them relative to a range of criteria that they put in place. And that, I think that has, even if firms have been dragging their heels a bit on how they implement that, the underlying concept, I think, was quite a radical one, and comes back to my point. Generally the industry has only shifted on fees when they've been nudged to do so by the regulator, and so sadly, then I'm slightly pessimistic about how this might pan out.
No, indeed, and I think the tension that you raise and the way you describe it, and how throughout the book you show in a number of different areas, the tension between the serving investors and serving so-called owners, serving limited partners and general partners, as it were, is something that will bear further scrutiny. And you're quite right that to observe that the FCA intervention on this is, somewhat radical in scope. And I might just draw a kind of parallel line to the comments we were making a few moments ago about alternative investments. To some extent, the more the FCA might get involved in regulating, what it would see as profitability in the asset management sector, the perhaps more enticing and interesting and attractive alternative strategies will become, because that tends to be primarily an institutional market and something that the regulator is likely to take a bit less interest in than obviously the mutual fund market per se.
No, I think that's absolutely right. I'm sure that's one reason why firms have been looking for a traditional asset manager to start looking at alternative strategies, private markets most recently. Absolutely, that's it's attractive for both those reasons, i.e. demand for those strategies and the sorts of fee levels they charge. And I guess more generally, if you look at an asset management business as a whole, bigger firms like generally to have different to have a diverse range of product types and strategies that they have. And private markets tick a lot of those boxes. And I think that's why you've been seeing interest as a result. And to the extent that now, generally, if you mention it to us, well, when I chat as a journalist to those people, obviously they tend not to reveal their innermost secrets. But generally you hear more asset managers talking about the price of those sorts of businesses has really gone up and become prohibitive as a result, because right now they're immensely attractive for a traditional asset manager to get involved in.
Indeed, and I guess these things always go through a cycle, because I can recall the prices of listed alternative manager shops like Blackstone and Man Group, sort of peaking out in sort of 2006, 2007, and then falling considerably in the intervening years of the global financial crisis, and then really only recovering slowly. But on a closing note, I just wanted to reference your quote from PIMCO's Bill Gross, which I really loved, and it sort of encapsulates the things we've been discussing for the last few minutes, where Bill Gross says, quote, "We sell hope, but very few are able to seal the deal with performance." I think that's, kind of indicative of some of the things we've been talking about. And I guess this is really the fundamental conundrum underpinning asset management, in that when people decide to invest with a manager, or indeed if you decide to buy a particular stock, to some extent you're looking at future prospects, but to a larger extent probably you're looking in the rearview mirror because you have that historical knowledge. And I guess the ability to sell hope and then deliver performance, you can do both of those things, you're bound to be very successful. But I guess obviously selling hope is the most important thing in the short term of getting money in the door. And I guess this is really a fundamental conundrum underpinning the asset management business. And I guess it's something that we'll continue to look at. What do you think?
Yeah, I agree entirely. Obviously, Bill Gross as well is nice. He gives that other conundrum, is whether you let your quotable fund managers out into the open and speak to journalists and the wider public. And in his case, it's obviously many column inches following what he said as a result. But no, I completely agree. And obviously that's that's obviously one reason I included it. I think it was a very nice way of trying to get to grips with, as I try to in the book, trying to get to grips with what the industry is about and what it is selling. This idea, it sells a service wrapped up in a product, But yeah, beyond that, absolutely, what they're selling is future performance, which is very difficult because no one can guarantee that. And the classic example being, what have been known as absolute return strategies, where you're not just selling hope, you're getting close to selling a promise that you'll be delivering an absolute return regardless of market conditions. And I think Bill Gross is a good example. You can only ever sell, this is what we're aiming to do, and this is the way that we're aiming to do it. I do think asset managers are caught as well between the short term and the long term. That obviously an asset manager really should be managing money for the long term, and pressure on them from flipping journalists and the wider public to be delivering over shorter time periods is very difficult to marry those two together. And I think firms that are honest and saying, what they're doing over the long term I think is where firms get it right, is where they're able to say that that's what they're trying to achieve, and that good shorter term performance tends to be, a byproduct of it rather than an aim of what they're doing. But how they do that and how they present that to the wider world is absolutely an ongoing challenge. Yeah, I would agree.
Well, that brings our half hour to a close, Ed. It's been a pleasure to hear your thoughtful discussion of some of the issues facing investment managers and how they balance those issues with serving their shareholders and serving their clients. And I'd like just to thank you for appearing on this edition of the Peregrine podcast. Ed's book, The Economics of Fund Management, is out now. It's available in good bookshops such as the Economist Bookshop, I would expect, and of course online at Amazon.com and other outlets. Thanks very much, Ed.
It's been a pleasure. Thanks very much, Bill.